This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the latest episode of the AJ Bell Money and Markets podcast. This week's episode has a big focus on pensions and lots of great material, whether you're still saving up for retirement or you're already in it. My name is Dan Coatsworth and joining me is Danni Hewson.
Hello there. As Dan says, pensions are the big theme of the week, and we've got a number of experts on the show to talk about some of the key issues. Pensions can be hard to understand, so hopefully you'll listen to this podcast and go away feeling a bit more confident about how they work and how to manage them.
AJ Bell's pensions and savings expert Charlene Young is here to talk through some of the key listener questions. All about managing money in retirement. So she'll be joined by AJ Bell's pensions and policy guru, Tom Selby, who's going to talk about how a Labour government might impact the pension system.
And we've also drafted in Laith Khalaf, who's going to share some of his thoughts on what you might want to do with your pension in those final years leading up to retirement.
Now, if pensions aren't your thing or you just don't want to hear about them, please don't switch off. We've got our usual look at the markets as well. We've got some really interesting things going on with Nvidia, the big tech sector, Shein and Frasers.
And Dan's also going to be talking to Schroders fund manager Abbas Barkhordar about investing in Asia. So hopefully we've got something for everyone. Let's kick things off, Dan, with everyone's favourite AI stock, because it's been on a bit of a roller coaster.
Yeah, so good old Nvidia hit the headlines, but for once, not for positive reasons. So over 3 trading days in the last week, we saw Nvidia's shares fall about 13%. But, if you just look at it that way, you think, okay, that's fine. These things happen with stocks and shares. They go up, they go down. But the value of Nvidia's decline amounted to $430 billion. So that does sound quite a lot of money, doesn't it? It's 16 times the value of Tesco. It's 56 times the value of Marks and Spencer. So what on earth is going on? I think all we had here is that Nvidia shares have had a massive run for the last couple of years. They've just kept going up and up and up. And all I can see is that it's simply this sort of sell-off in the business is simply down to people taking a bit of profit. And I think that this is a business where it's clearly been powered by expectations for the business to do well. It's plugged into all things AI. More companies look at AI, invest in it. Theoretically, Nvidia should see its earnings increase because it's like the go-to company for chips to process all this power. Now it's done incredibly well. Like I say, quarter after quarter it beats earnings expectations. But what really is going to happen is come August, this is going to be the next set of quarterly results. I think that's going to be the real test for it. So I think that if it can't beat expectations again, I think lots of people are just going to go, is that the top for the stock? Because we don't know. No one knows what's going to happen next. But I just think it's quite interesting how the market seeming a little bit sort of more jittery. And I wonder whether this is going to just increase in the lead up to what's going on. I mean, big tech in general has been in the headlines as well. So, Danni, I know that you've been looking at some of the other things involving names like Apple.
I have, and I just wanted to ask you before we move on, is this something which companies have to think about when they go down the route of a stock split? Because we saw this initial surge with Nvidia after it did its 10-for-1 stock split at the beginning of June. But then, of course, you've got investors that had a small number of stocks that suddenly had 10 times that number. So it made profit taking maybe a bit easier. They could still hang on to a few, but they could also sell a few.
Yeah, I mean, it certainly did. It seemed to attract sort of more buyers initially. But obviously, I guess if someone buys something and they make a quick, say, 10, 20% in a couple of weeks, it's only natural some people would go, well, I'll get out while the going's good. But I don't think companies should really think too much about stock splits in terms of managing their share price beyond simply, they do it to try and make it make the stock more affordable for investors, but they're taking a long-term perspective on that. I guess if your share price is more than $1,000 per share, that excludes a lot of people from who won't be able to afford a single share. Knock it down to in the 100 territory, it's a bit better. But I think with Nvidia, it's just everyone sort of focusing on it. I think the key thing here is that when that share price fell quite a lot over 3 days, of course that leads to questions. People saying, is this it for the stock market? Are we about to see a big correction? But as we're recording this, we've just had a day where Nvidia shares they're up nearly 7% in a single day. They're bouncing back. So I think that that certainly helped calm markets. Of course, by the time you listen to this podcast, who knows? It might have gone back the other way. But I think even with we've had some news around EU regulators clamping down on big tech, but that's not really caused too much drama in the markets, has it?
No, it hasn't. And as you say, we're recording this on Wednesday morning. So whenever you're listening to it, just bear that in mind. And it's been really interesting to watch those top companies because there's been a lot of jostling for position about which company would be the most highly valued publicly listed company. And we saw Nvidia overtake both Apple and Microsoft and then slip back down. And Microsoft and Apple have some of their own concerns, along with some of the other big tech players as well. And as you say, this is because of a new EU Digital Markets Act. It came into force last month, and its aim is to really control the behavior of big technology companies and regulate some online marketplaces. There's been a lot of thinking over really the last couple of years from regulators in the UK, in the US, in Eurozone, really thinking that maybe some of these big tech companies have got too big. They've become too dominant at the expense of other players. And both Apple and Microsoft potentially now face pretty big fines from European Union regulators. I'm going to start with Apple because it has been accused of breaking tough new digital competition rules by preventing app developers from freely directing consumers to cheaper services. It's something which has been discussed for a long time, and Apple does have a chance to respond to these findings. The Commission's taking a more time to look at it. It's got to make a final decision on Apple's compliance by March 2025. So a little while yet. But when you're talking about the fines, this could be up to 10% of its global revenue. So for Apple, you're talking potentially about 38 billion based on 2023's accounts. Now, we know that Apple has been in discussion with the Commission about trying to abide by some of these rules, but they've already been fined 1.84 billion euros, $1.97 billion for preventing rival music streaming services like Spotify from telling iPhone users that they could find cheaper ways to subscribe. That was the bloc's first ever antitrust penalty on the US tech giant. We've also got Meta and Alphabet under scrutiny, and Microsoft. The European Union says it has violated antitrust laws, and this is down to the way that it bundles up Teams with some of its other popular applications, things like Office. So again, this potentially could result in a whopping fine, about $21 billion based on its last financial year's global revenue. It follows a complaint by the internal messaging app Slack, which is now owned by Salesforce. It's alleged that Microsoft had given Teams an unfair advantage because, as I say, it bundled it up in the Office software, and thereby it denied Slack an opportunity to compete on a level playing field. And that is the thing that the European Commission is really concerned about. It is about trying to create a level playing field for not only those massive companies, but also for the smaller companies that would like to have a bite of the cherry as well. Now, Microsoft's President Brad Smith has said, look, we have made some changes. We've unbundled teams. We've taken initial steps, and they're going to work to find solutions to address remaining concerns. And that's exactly the same as Apple. It says it's made a number of changes to comply with this Digital Markets Act, and it will continue to listen and engage. But I think it is something that investors need to really bear in mind. There is an awful lot of focus on regulators, on big tech at the moment, and on this ability to create a global fair playing field.
Yeah, I think another thing that people should be thinking about is when they're obviously looking for investments. I think a lot of people just look for the positives. They're just trying to think, okay, here's a company, what's its growth prospects? But you do need to think more about the negative stuff. What could hurt it? There is a view that some of these big tech companies they'll get fined, they'll pay the fine, they'll just move on. But the EU has been flagging this for quite a while, that it really wants to promote competition, and it doesn't think some of these very gigantic companies should be so dominant. So this one is by no means I don't think it's going to be a one-off incident here. I think we're going to see lots more of this sort of stuff. Let's talk about Shein. So the Chinese sort of online fashion company. It's growing very fast. It's in multiple countries around the world. Lots of talk about it wanting to list on the stock market. Well, it was looking at the US first. Then, I don't think the relations between US and China really could mean that it's going to list there. So I think we've seen that the conversation has shifted to, could Shein list on the London Stock Exchange? So over the last week or so, we've had, I don't know, quite a lot of negative comment from institutional investors, from media, about basically sort of questioning Shein's business model, saying like, are you associated with suppliers who are not treating workers fairly? How are you able to sell clothes so cheaply? Does it mean that essentially the supply chain is a bit sort of not up to the standard that people should expect from companies? So lots of sort of pushback, and then so speculation that the Chinese government doesn't like all this criticism, and essentially sort of is going to say, sorry, we're not going to give you approval to Shein to be able to list in London. Fast forward like almost 24 hours, we suddenly got more market rumors saying, well, actually Shein's already started to file some paperwork, and actually it might have happened last November. It sort of reeks to me that someone, potentially sort of PR representatives for Shein are sort of trying to sort of manage the conversation in the press by sort of or making sort of hints that things are perhaps still on track, but at the moment, I think as almost like we go on a weekly basis, I think it's going to be harder and harder for this company to be able to list here. Even though the London Stock Exchange probably wants it to list here, I think that quite a lot of institutional investors don't want to get burnt by sort of backing a company whilst it's growing fast. It's a disruptive force in retail. There's still so many unanswered questions, and it doesn't seem very transparent. So, I guess, Danny, how much have you been buying from Shein recently?
See, my kids bought a lot from Shein, but as they've got older, because it always sat very uncomfortably with me, but they're at a point now, particularly the eldest, where she's got a job so she can buy her own stuff. And it is remarkably cheap, ridiculously cheap. And it's the sort of stuff that they want to wear. But I have to say that in the last few months, they've been buying less because they are concerned. They are hearing some of the reports, and they are worried about the practices of some of the supply chains. So even though Shein is saying, look, we're all above board, there's no issues here, and therefore a London listing, it should happen. There shouldn't be any issues with it. They're now buying actually more second-hand clothing because they want to make sure that they're not contributing to the great big rubbish piles of clothing, which is just sort of rotting. But also because just generally they're hyper aware of their world and their place in it. So I think investors are right to be slightly wary, but also you can completely understand why there is such excitement about potentially a listing of this size, because it would be a massive shot in the arm for London markets.
Yeah, absolutely. So just one more thing on retail before we go on to our pension stuff. Should we talk about Frasers? There's a company that, I guess if you're not quite familiar with that name, it's the parent company for Sports Direct, and lots of other things. Loves to find new ways to make money. Looks like he's got another one now. What's been going on there, Danny?
Yeah, Frasers is interesting, and it's kind of run on parallel lines in many ways to Next, which of course is another great big high street behemoth. And one of the things that Next has done incredibly well is create a finance offer. And in fact, I was looking into the numbers, and it made 18% of its trading profits from its credit offering over the last financial year. So it sort of demonstrated the value of more than just selling stuff, but actually finding new ways to get them into consumers' homes. So Next has been brilliant at not only delivering its own stuff using its own credit facilities to people, but also having a whole load of other labels, some of which it owns, some of which it owns a little bit of, others it's just offering up on its platform. And that is something which Frasers has also been edging towards as well. So, it's got a lot of companies in its own right, but it's been taking on big stakes in a number of retailers, including AO, Boohoo, ASOS, Hugo Boss, Currys, Mulberry. I mean, there's a long, long list of businesses which potentially it could make money on if it were to offer up its Frasers credit to those customers. And it's made a big move, which initially, I know that you were saying it might not seem exciting, but strategically, it could be hugely important because it's entered a partnership, a payment and logistic partnership with THG, the Hut Group. So it then gives it a shop window to show off those skills that it has and potentially say to other businesses, hey, look here, you could use our platform, our credit service as a way to sell your stuff. Look at how good we are. And it's coming a little bit late to the game, you've got to think, because there are quite a lot of existing buy now, pay later offers. In particular, I'm thinking about the big ones, Klarna and PayPal, which are established, which when you go on a lot of websites, they're the first thing you see when you hit the checkout. But for Frasers, this potentially could be a really, really good way to enter the market, because this is a company, Dan, which has made a real art out of maneuvering from what it was, that pilot high Sports Direct model, into offering a whole variety of different products. I often think of it a bit like a monopoly board. It feels like they've been going round and rolling the dice and landing on one of the boards and buying up the next high street outlet. So this is one way that potentially it could, become even bigger.
Now, before we bring on the first of our pension related guests, I wanted to explain why we're going heavy on retirement money topics on this episode of the podcast. So at AJ Bell, we're passionate about helping people to invest, and pensions is one of those areas where people know that they need to put away as much as possible, but they don't always understand the rules, and many people don't always have a plan in place. So we've been featuring a range of pension articles on AJ Bell website this week, and on Thursday night we held a free webinar that you should now be able to watch on our website via the catch-up service. Charlene Young was among the presenters for the webinar, and she's here today on the podcast to run through a few common pension questions. So, hi there, Charlene.
Hi, Dan. Thanks for having me on.
Hi, Charlene. To kick things off, I know that there's a lot of confusion about when someone can start taking money out of their pension. Can you run through the rules?
Yes, so the minimum age you can currently take money out is 55. As the state pension age is increasing to age 67 between 2026 and 28, the government has changed the rules. So this minimum age is going to go up from 55 to 57 from April 2028. Now, some people, usually only those in what we call occupational schemes, will get some protection and possibly get to keep the earlier age of 55. It does depend on the rules of the pension scheme they are in, though. So the best way to find out is just to get in contact with your provider and ask them. And as I say, big changes can cause a bit of confusion. And as a rule of thumb, it won't generally affect you if you reach age 55 before 2028, or if you're not planning on taking your money out until you're at least age 57.
So obviously we talked about the first time you can take money out of a pension, but what about turning to the end? I know this sounds a bit morbid, but a lot of people want to know what actually happens to your pension when you die, and why are people saying that the tax rules are so generous?
Yeah, so this has come up quite a bit in the press recently as well. So, money in a pension builds up tax efficiently. So, it's free from income tax and capital gains tax on the investments you've got in your pension pot. And then, when this money is passed on to loved ones, it's usually sheltered from inheritance tax too. So, you can nominate someone to receive your pension money by filling in a nomination form, or it might sometimes be called an expression of wish form. So you tell your pension provider then a name and a percentage that you'd like to potentially leave to them. But as well as individuals, you can actually nominate charities and or trusts depending on your circumstances. It's really important to make this nomination though, and to also check in on it every now and then. I say a good rule of thumb is to generally do it when you're reviewing your investment portfolio, as well as after any kind of life events or changes in your circumstances. So if we stick with individuals here for a second, your beneficiaries can then usually choose how to take any funds that are passed to them. So they could take them all as a lump sum, or they could leave it in a pension in their own name to give them an income at any time. So, in terms of the tax, anything taken as an income is always tax free if the pension saver died before age 75. So, that income could also be an annuity payment, but a payment from drawdown as well if they left it in a pension. That payment from drawdown itself could be a regular payment, but it could also be a single one off payment as well. So, if someone dies before age 75, any lump sums paid from their pension scheme are generally tax-free too, but there is a check in on the new lump sum and death benefit allowance too, which you don't get with that income option. Now, drawdown, as we talked about, is usually an option for your beneficiaries if you're in a pension like a SIP, but not all pensions offer it. So it's another thing worth checking when you're perhaps refreshing your nomination form with your provider. So if you want to know a bit more about that and the flexibility that comes with some of the death benefits, please catch up on the webinar because Rachel and I go into quite a bit of detail on that and who and what you can nominate. And there's also an article on our website if you really want to get into the detail and see a case study.
Thank you, Charlene. Let's bring on AJ Bell's Laith Khalaf now. Now, when you're building up a retirement pot, you're looking for growth, and then once in retirement, you want income. But what about the bit in the middle when you're nearing retirement but not quite there yet? Laith, what do people need to think about?
Yeah, hi Danny. Yeah, absolutely. So it's a bit of a tricky period because, as you say, it's easy-ish when you're building up your pension. You want growth. In retirement, you want income. In between, what do you do? And the risk is that by going all out for growth, when you're building up your pension, as you approach retirement, a couple of days before you retire, we have something like the financial crisis. You end up seeing a very big market fall and have to retire on less. So that's the kind of big crisis that you want to avoid. The traditional approach to this is something called lifestyling. It was quite prevalent and is still quite prevalent in a lot of pension plans. And what that does is it gradually shifts you out of growth funds or shares, equities, and into bonds, into what are called annuity hedging funds. So these are funds which move in the opposite direction to annuity rates. Now, some people might not even know what an annuity is, and actually many of us don't know what an annuity is unless we're involved in financial services or we hit retirement. An annuity is basically an insurance contract. A lot of people used to get an annuity when they got to retirement. So you hit retirement and you take your pension pot, £100,000, let's say, for instance, and you go off to an insurance company and say, can you give me a fixed income for life? And that used to be a very prevalent way that people took a retirement income. And these lifestyling strategies basically invest you in funds which move in the opposite direction to the annuity rates. The idea is that as you're approaching retirement, you're invested in something which is hedging the volatility of your income. So if annuity rates are going up, your fund is going down, but then they should even out. And the flip side is true as well. If your fund's going up, annuity rates going down, you're reducing the volatility of your ultimate income. The big problem with that approach is that very few people are now buying an annuity. So it used to be the case that 90% of people, when they hit retirement, bought an annuity. We then had the pension freedoms introduced almost a decade ago. And since then, it's been the other way around. So only 10% of people are buying an annuity. So actually, a lot of people are still in these plans or have this lifestyling program going on in the background, and are actually not going to be buying an annuity. And the problem there is that if your fund value goes down, which it did quite heavily in 2022, and a lot of these bond funds fell by about 30%. If your fund value goes down and you're not buying an annuity, then you're not getting any hedging. So your income isn't going up. So that's a problem for the traditional approach. Lots of people still have these approaches in their older pensions, things like stakeholders. A lot of them run by insurance companies. So I think if you do have, one of these, kind of older pension plans, it's worth having a look, whether this kind of automatic shifting is going to happen when you hit a few years out of retirement. So that's the traditional approach. And, it is flawed unless you're buying an annuity. If you are buying an annuity, you might still be happy with it. But a lot of people are now taking two other options. One is, they're just taking all the cash out of their pension, or the other option, which is that they're keeping it invested and drawing an income from it. And I think what the lifestyling example shows is that what's important when you're thinking about how you're investing as you approach retirement is actually how you're going to draw your retirement income. Because whether it's an annuity or cash or keeping it invested, all of those three different approaches require different things from your investment strategy as you are approaching a retirement. So, for instance, if you're just going to take all your pension as cash, might not be a great idea because, if you're going to spend it all, then what are you going to live the rest of your retirement on? But if you are going to do that, then what you might like to do is gradually switch into cash so that, the day before that you retire, you are sitting in cash. There's no big market fall. And so, you've taken out a lot of the risk from your portfolio. If you're keeping your money invested, which a lot of people now are, and drawing an income from it, then actually it's a bit more tricky because you need to think about what does my income portfolio look like in retirement? What is the point I want to get to at retirement? And then again, you can gradually transition your investments across from your kind of growth phase, gradually sell out of your shares, maybe keep some shares, probably keep some shares, in fact, but also move into things like bonds and cash as well, so that when you hit retirement, you've gradually de-risked your portfolio to a point where you want it to be to produce your retirement income. So there's quite a lot to think about. It's quite a tricky phase in the kind of pension investment journey, I think, but it's definitely one that you need to think about, and probably you need to start thinking about it, I think, 10 years before retirement, with a view to starting shifting assets somewhere around 5 years before retirement, depending on market conditions. And of course, you can kind of adjust things as things go along, depending on kind of any changes in your personal circumstances, for instance, or your attitude to risk. If, for instance, you receive a big windfall, for instance, an inheritance, which means you feel you can take a bit more risk with your pension. So that's kind of a pricey, again, kind of, if you want a bit more information, we've covered it at length in the pensions webinar, which is available online.
Thanks, Laith. Now, we're only days away from the general election. There might be a big change in number 10. And that's got a lot of people asking what it means for their personal finances, in particular, what it might mean for pensions if we get a Labour government. So I'm hoping Tom Selby has the answer. Tom, please tell us what might happen.
You're asking me to get my crystal ball out. This is a man who predicted that England will get to the final of the Euros, so I'm not sure you should trust me on that. We do have a little bit of information from Labour on what they may do on pensions, but not a huge amount, to be honest. So they've pledged to undertake a review of the pensions landscape in their manifesto to consider what further steps are needed to improve pension outcomes and increase investment in UK markets. So I think that's one of about 13 different reviews that have been announced in that manifesto. Now, there was a document that was published in January, which I understand still stands, which focused on financial services and gave a little bit more information on what that review might focus on. So it said that the review will look at the current state of the pension and retirement savings landscape to evaluate whether the current framework will deliver sustainable retirement incomes for individuals. We've seen the current government, through the Mansion House reforms, looking to corral more pension money from occupational schemes, so big defined benefit schemes, for example, to get them to invest more in UK companies rather than in overseas companies, to try to get the economic growth that's been so evasive for the UK for the past 2 decades or so. So I think it's fair to say that both the manifesto and that January document leave quite a lot of room for manoeuvre for Labour if they do win the election. A couple of obvious ports of call. So I mentioned the fact that they're going to continue this drive to get more occupational pension money in UK assets. We'll see exactly how they're going to do that if they win and set out a much clearer plan. There are also proposals that are in the pipeline to scale up automatic enrolment. So there were some proposals put forward in 2017, which would see the lower earnings band against which minimum contributions are based removed, so that your first pound of earnings qualifies for both a matched contribution from your employer and tax relief. And there were also proposals to reduce the minimum age for auto enrolment from 22 to 18. So we may see the Labour government look at those reforms if it wins power. Crucially, because of the broad nature of these reviews, I think you're always going to get quite a lot of rumour and speculation about what it might mean. It's not beyond the realms of possibility, for example, that they could look at the tax rules around pensions, although there's been no indication either in these documents or in any of the public pronouncements from Labour that there's anything in the pipeline on that, although speculation is inevitable, and we've already seen some of that in the last couple of weeks. The one thing we know that Labour has now ruled out is reintroducing the lifetime allowance. So that was the just over £1 million lifetime limit that was abolished on pension savings, that was abolished by the current government in April of this year. So that's not going to come back, which is good news, I think, for simplicity in the pension system, and also good news for people who are potentially bumping up against that lifetime limit. I think the most important thing in this period is for savers and investors to try to ignore some of the inevitable noise that we're going to get around these policies. And this review, as I say, is quite broad potentially in scope, and so there's lots of room for rumour and speculation to fill that void of information in the interim. I'd say ignore the noise, as always. Focus on your long-term goals and make the most of the tax incentives that are available today in line with your retirement plans, rather than trying to second guess what a potential future government might do when it's in office, because at the moment we just don't have enough information to make those kind of decisions on.
Great. Well, thanks very much, Tom. Before we wrap up our pension special, Charlene's been looking into the trend for people to move their different pensions into a single pot. Now, AJ Bell has just launched a quite nifty product which could help people looking to do this. So tell us all, Charlene.
Yeah, so there's a couple of dizzying stats that often pop out when we talk about lost pensions. So the first is that 1 in 4 UK adults supposedly has lost track of a workplace pension. And another is that there's £27 billion in lost pension pots in the UK, although some estimates suggest it could even be significantly more than that. So as we change jobs over the courses of our careers, we might build up lots of these different pension pots. And let's be honest, keeping track of them isn't always high up on our to-do list. And the annual statement that you get might just be a little bit grey and boring and go straight into that shredding pile. So with that in mind, we've launched a ready-made pension to help people who are saving towards retirement, so in that stage of building up their pension funds, who want a simple, low-cost account that's easy to manage. So they might not want or be ready for a full SIP at this stage, but they still want to get started and organised. So at the moment, I should say it's only available to brand new AJ Bell customers, but the team are busy working on it so it can be available to existing ones too, and sit proudly alongside our kind of full self-invested SIP as options for people saving for retirement. So 3 key parts really to the ready-made pension. Number 1, there's a free pension finding service. So if you have completely lost track of your pensions, or you've got a fair idea and you just want some help rounding them up, you can do that with just a couple of details on where you've previously worked in the past. So you don't need reams of paperwork. We take care of tracking them down based on your employment history, and we'll keep you in the loop along the way. Second, in terms of investment choice, so we shrunk it right down, and there's 4 low-cost AJ Bell funds to choose from. So just to keep it really simple, so from an adventurous asset allocation down to a cautious one, and also a responsible option too. Now, with this product, there's 1 annual charge for all the features of the product, and that's taken from that fund. So there's no dealing charges or other fees there. And thirdly, as well as managing the fund investments, we automatically invest any cash that you pay in for you. So that could be new money from contributions, tax relief top-ups from the government, and of course, cash from pensions that we find for you and transferred across. So, of course, I'm not giving you advice or a recommendation here, and the usual pension rules do apply, but there's plenty of information about it on our website if you'd like to know more about the features.
Thank you, Charlene. Now, at the start of the podcast, we promised you an interview about investing in Asia. So let's bring on our final guest. Abbas Barkhordar is a fund manager at Schroder Asia Pacific and Schroder Oriental Income, and he joins us now to talk about investing in an interesting part of the world.
So, Abbas, a lot of investors are interested in having exposure to Asia. It does provide a different dynamic to the portfolio, but I think there's often a mistrust in Asian companies because they're perhaps not always familiar names to people who might be in the UK. There might be a lack of knowledge about how politics and markets work in that part of the world. So where would be a good starting point for someone if they were looking to invest in Asia?
Yeah, I think that's very true, and in a sense, there's fewer household names, if you like, in Asia. But the first thing I would say is that it's a fantastic region, and it's got lots of great industries and lots of great companies, which are really tied into a lot of our sort of daily lives and a lot of our industries and supply chains. Most investors, I think, will know that Asia still is the key manufacturing hub of the world. And that does provide a lot of opportunities for investors, given the importance and reliance of the rest of the world economy on Asia. So I'd say you're absolutely right. There is sort of a lack of, knowledge of some of the leading names, but that doesn't mean there is an opportunity from an investment point of view. Your other point is also very true. There is a lot of volatility in Asian markets. That's not unusual, and it's not something new. And politics, whether it's local or geopolitical, does impact markets and has done historically as well. But I would say that's again nothing new. It's something that experienced investors have dealt with and know how to position portfolios for. So I would say that it's a great region for investors, but it is one where you do need to be quite selective, and there's room for a lot of judgment. Our approach is to have a lot of experienced analysts, professional investors on the ground in the region who've been looking at those markets, looking at those companies, looking at those countries for many, many years, and are very familiar with the politics, the regulations, the company management, and the opportunity sets. And that's the best way, I think, to invest in the region, is to do that really fundamental research, bottom-up research on the companies and industries that we're investing in. So I think it's a great region. It's a great region for active managers to add value. And I think all investors should really consider having Asia as part of their portfolios.
I guess it does play to the strengths of using the services of a fund manager, whether it's an investment trust or an open-ended fund, rather than picking stocks yourself. I guess if someone's located on the other side of the world, unless they're an absolute expert in investing, it must be plays to your strength. I mean, is this something that I don't know whether you actually ever get to talk to your investors? Is something that they, the reasons why they've chosen your products? So they mention that at all?
Yes, and we do talk to a lot of our investors, both the sort of intermediaries, the wealth managers, but also the end investors as well. And I think it's clear, when we do talk about the companies we're investing in, the industries we're investing in, there's a lot of interest in that. But as you say, the sort of knowledge base is obviously lower than if you're investing in regions that you're more familiar with. Now, obviously, I work for an asset management firm. I would say it's in everyone's best interest to invest through us. But I think that is borne out historically. It is a region where active management and that fundamental bottom-up stock research can add value over and above what you get from the market returns.
Yeah. I mean, there used to be an argument in favor of geographical diversification for an investment portfolio because people sort of assume that one country might move at a different pace to another. I was just wondering if you thought, does that argument still apply today, or is actually it's no longer true because everything in the world does seem to be interlinked by global trade?
Yeah, I think it's interesting if you look at the sort of time frame. Yes, of course, the world has become more globalized in the sort of long term. But actually, in the last few years, there's been quite a lot more fragmentation around trade. And that's actually been particularly obvious in Asia, as I mentioned, still the key sort of global manufacturing hub. But supply chains have definitely looked to diversify in the last few years. Historically, there's been a lot of reliance just on, for example, China or really any one single country. And I think a combination of geopolitics and the sort of mood around that, plus the sort of fragility of relying on just one sort of country or one region within a country was sort of shown up by the disruptions we saw during COVID and clearly supply chains getting scrambled and shortages of many goods. So we've actually seen quite a lot of supply chain rejigging and restructuring over the last few years. Some industries actually, and the most obvious is high tech and the sort of leading edge semiconductor industry. Those have started to actually bifurcate between sort of Chinese and then non-Chinese supply chains. So there is actually a lot of change going on in that area. And I would say Asia as a region, as certainly our sort of investment universe, is very heterogeneous. It's what drives things in India is very different to what's going on in China. When we look at Taiwan, totally different considerations to what's happening in Indonesia, Korea, Singapore. All of these areas have very specific separate drivers. And in a way, geographically, it's a region, but from an investment point of view, it's really very diverse. And you get very different moods, sentiments across countries. At the moment, India and Taiwan are particularly in favor, whereas China, Hong Kong, for example, are much less favored. Rarely do you see the same economic cycles across markets. Some markets like Korea are much more tied into the global economic cycle, whereas India, for example, is much more domestically driven. And as I said at the beginning, we've got a huge variety of sectors and industries. So I think there is still very diverse drivers across Asian markets, both within the region and, to your point, compared to global portfolios. So I think there is still an argument in favor of that sort of geographical diversification because of those different drivers.
So when you're sort of doing research on Asian companies, trying to work out which stocks to buy and which ones to avoid, what are the sort of the classic red flags you find when you're doing your research process?
Yeah, it's a great question, and it speaks to what I was saying earlier about having that experienced team of investors on the ground who can spot those, signs of, well, hold on here, we need to do a bit more digging here. It seems too good to be true, or, but I'd say our first starting point always is, we've got a quality bias in terms of the stocks we want to buy. And that speaks to both the sort of returns they can generate. We're looking for companies that can make sustainably higher returns on investment than their cost of capital, which actually, knocks out quite a lot of the investment universe. But critically also corporate governance. And that's really a key consideration. So when I said earlier about our analysts on the ground and fund managers on the ground having long experience of the management track records, I think that's really critical. And it's not just the management. You've got to consider who are the major shareholders of the companies you're investing in. What are their other interests? Are there related party transactions where they're using the listed vehicle, say, to benefit some of their other unlisted or outside interests? So all of those things are classic sort of red flags, as you call it. And really, it comes down to the fair treatment of minority investors. We are minority investors when we go into these companies. We don't typically have much influence in terms of board level, or we do obviously engage with them, but we don't own the companies. So it's very important that we're comfortable that there's a track record of fair treatment of minorities, and that there isn't any sort of big misalignment of interests either with the managers of the companies or the ultimate sort of beneficial owners of the companies. In addition to that, there's the sort of traditional sort of accounting red flags. We obviously model each of the companies that we're investing in. We look through the financial statements, looking for things like cash flows. Are they not quite appearing as you might expect? Is there leakage on the sort of working capital side? Are there signs of hidden debts? And there's a lot of tools you can use to help you with that analysis. But ultimately, it comes down to what I was saying about the sort of capital allocation of those companies, the returns that they can make on them. And it's really important to be aware that even if it's a good company, it might be in an industry where it's very difficult to make good returns because there are high competitive intensities. There's too much capital that's gone into that area. One area I'd sort of give as an example of that, if you look at some of the renewable space in China, I think most investors are aware that China has become an absolute powerhouse in the renewable energy sector, whether it's solar power, wind turbines, electric batteries, EVs. There's a huge amount of investment that's gone in there, and it's seen a lot of growth. But actually, as an investor, you won't necessarily have made much money out of that because there's been so much capital in that area, so much competition, so much expansion of supply, that actually returns on investment have not been that high. So there's that slight distinction you've got to make between it could be a good company, but if the industry as well is under a lot of pressure, then that to us is a sign where actually investment returns may not be so good.
And just finally, I just want to ask you, where are you seeing sort of the best opportunities at the moment in Asia?
Yeah, and it's a good question because there's so many different sectors and industries and companies that we can pick from. At the moment, I'd say where we're particularly keen on one area is IT, and I should say when talking about tech, investors who think about global markets or US markets may think more of the sort of software or internet names. Actually, in Asia, when we talk about tech, it's largely tech hardware, so manufacturing of high tech, and particularly in semiconductors. So really the hub of global semiconductor manufacturing, whether it's for logic chips, things like AI, 5G, CPUs, that's largely in Taiwan. And then memory, which is the other main type of semiconductor chips, which is largely a Korean manufacturing and Korean companies that make that. A lot of that is very concentrated in Asia, and it's very concentrated in a few companies. So they typically make pretty good returns because it's a very high barrier to entry industry, very, very difficult thing to make leading edge chips. It requires a lot of capital and a lot of built up know-how and intellectual property. So those are very good returning companies. And at the moment, we're seeing pretty good drivers, both cyclically and structurally, for IT. So post-COVID, there was this huge shortage of chips, as you probably remember, in 2021 affected all sorts of industries like car manufacturing, which couldn't get the chips they needed. Then there's been this glut because supply came online just at the same time as you had higher interest rates, higher inflation, hurting consumer wallets in the West. And we're just getting through that now. So inventories are now back to normal, and you've got this sort of supercharged demand cycle driven by AI investment by lots of companies who feel that they need to have some AI capability over the last sort of 12 to 18 months. So there's definitely a cyclical recovery in IT, but structurally as well, we all know the economy is becoming much more digital, much more semiconductor intensive. And as I say, that manufacturing, all of that manufacturing pretty much is being done in Asia in a handful of companies who can therefore, really reap the returns that come from having that concentration in that industry.
That was Abbas Barkhordar from Schroders. And that is it from us this week. I hope you enjoyed this special episode of the podcast. And don't miss next week's episode, where we'll be talking about the impact of the general election result on markets and money, as well as bringing you a deep dive into a fascinating stock by the team at Shares magazine. Thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.